Ever wonder if your trading strategy is actually working? You have put in so much time and efforts, but how do you know if it is worth it? Hi everyone, I'm Ryan from the Tradveller. Today, we are breaking down 3 key performance metrics that can tell if your strategy is a winner or a flop. Let us kick things off with the Sharpe ratio. Think of this as your strategy's report cards. It tells you how much return you are getting for the risk you are taking. Think of it like investing in 2 different businesses. One business is stable and give you consistent return with little risk, like a well-established coffee shop that always have a steady stream of customer. The other business is a high-risk tech startup that can either make you loss of money or loss a lot. The Sharpe ratio helps you to figure out which business gives you a better returns for the risk you are taking. A high Sharpe ratio means you are getting a good return without taking too much of risk, while a low Sharpe ratio means you are taking a lot of risk for not so much reward. Let us imagine 2 different strategies. Strategy A and Strategy B. Strategy A gives you a steady return month after month with a very few losses or minimal losses. It is like a slow and steady race where you can gradually build up your profits. On the other hand, Strategy B is a roller coaster ride. One month you might double up your money, but the next month you could lose half of it. The Sharpe ratio helps you to see which strategies is more reliable. A high Sharpe ratio for Strategy A means it's giving you a good returns with less risk, making it a safer bet. However, Strategy B with a low Sharpe ratio indicates that a high risk doesn't really justify the returns. In summary, to make it simple, higher Sharpe ratio equals to a better risk-adjusted return. It is like having a smooth and enjoyable ride instead of a bumpy and an unpredictable one. Next up is karma ratio. This one is all about balancing your returns with your worst losses. It is like a strategy way of saying that I can make you money, but at the same time, I won't let you lose too much. Think of it like sailing. A high karma ratio is like a smooth sailing with a few manageable waves. You are not getting too many big surprises, just a steady progress. On the other hand, a low karma ratio is like trying to sail through a storm. It is so much riskier and harder to stay on course. For example, let's say you have 2 trading strategies again. Strategy A has a high karma ratio, meaning it makes a good return while keeping the losses small and manageable. It is like sailing through on a sunny day with a gentle waves. You know there will be some ups and downs, but nothing too dramatic. Strategy B, however, has a low karma ratio. It might still make you some money, but it also takes a big hits along the way. Like trying to sail through a storm with a huge waves crashing over your boats. The journey is rough and you are constantly worried about capsizing. As a summary, higher karma ratio equals to a good returns with a manageable risk. It is about having a smoother and more predictable journey, which is less stressful and more enjoyable. Finally, let us talk about maximum drawdown. In short term, MDD. This matrix shows the biggest loss from a peak to a low point. It is like measuring how far you have fallen from the highest point before even bouncing back. Imagine you are climbing a mountain. If you slip and only fall a few feet before catching yourself, that is a low maximum drawdown. But if you slip and fall all the way to the bottom, that is a high maximum drawdown, a much scarier and a more dangerous fall. Let us look at 2 more strategies. Strategy A has a low maximum drawdown, meaning it only loses a small percentage from its peak before recovering it. It is like climbing a mountain and occasionally slipping, but never falling too far. This keeps your capital relatively safe and your stress level low. On the other hand, Strategy B has a high maximum drawdown. It experiences significant drops, sometimes even losing a big chunk of your investment before it starts to recover. It is like climbing and falling into a deep ravine, which is not only scarier, but also take a lot of effort to climb out of it. To sum it up, a lower maximum drawdown or lower MDD equals to a less risk of a big losses. It is about protecting your capital and ensuring that even when you face setbacks, they are not so severe that they are hard to recover from. And there you have it, the 3 key performance metrics to check if your trading strategies is profitable. Sharpe ratio, karma ratio, and maximum drawdown. These tools can help you make a smarter decisions and keep your trading on track. By understanding and applying these metrics, you can evaluate your strategies more effectively and make a more informed choices and decisions that can enhance your trading performance. Whether you are a beginner or an experienced trader, keeping an eye on these metrics can help you navigate the markets with a greater confidence and stability. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more greater content. And also, join our Discord communities where you can share your strategies, ask questions, and get support from the fellow traders. The link is in the description below. Thank you guys for watching and happy trading.